if you are an avid credit card user, listen up. They are snatching credit limits away from people right now. Credit card companies are cutting their limits without warning, and I don't want you to get caught in that crossfire, so please stick around because we are going to be talking about which companies are slashing, what you should do if you want to kind of hold on to that money in your own liquidity, and also some other options for you to get money that you might not know you have access to. All that and more, so keep it locked. This is Crystal with the Cash Compass. Alright, welcome or welcome back. I am here to teach you all the things that you should have learned in school about money, but for whatever reason, they forgot to mention it. Please be sure to subscribe because we talk about everything from personal finance to investing to the economy. Let's get into it. Alright, so yes, yikes. If you had $10,000 of credit limit and you open up your app to see $5,000, here's why. It's a magical word called liquidity. And there is potential to be an extreme liquidity crisis coming up, which is having companies all around becoming much more protective of their coins. What you're seeing right now is seriously unprecedented. We're living through history. I know we technically are living through history every day, but you know what I mean. A lot of people are allowed to have mortgage deferrals. They're not paying their mortgage, and even if they don't have that deferral option, they're not paying it because they don't have the money, because they don't have their jobs. So what's not getting paid? Mortgages aren't getting paid, car loans aren't getting paid, other expenses are not getting paid because people have to pick and choose where their money is going to go. And that might mean for some person they have to pay their mortgage, for others it might mean they have to just pay to get their own food. So the banks are suffering. They are not getting as much money as they could because people are just not going to be paying, and it's only going to get worse because, like I mentioned in my previous video, even when this subsides, people are still not going to have jobs to go back to, so we're still going to have to deal with unemployment and people having to penny pinch, people getting evicted and the like. So when that happens and the banks are seeing, okay, we are going to be running out of liquidity because we've given all this cash out, we're not really getting anything back in. So now we need to be a little bit more tight about what we're doing. Chase has already put restrictions on who they're going to be giving mortgages to. A lot of banks have also said, we're not going to let people refinance right now because they are just not wanting to take in any more risk, which I don't understand, but that's another topic for a different video. I don't want to go off on a tangent. Couple that with people already knowing, hey, this is getting really tough for me. I'm about to just max out my credit cards and then go ahead and file bankruptcy. People will do that, and they know this because they've been down this road before back in 2008. Only difference is everything. I mean, things are a lot different, and I'll have a video talking about comparisons between 2008 financial crisis and this one, so make sure you are subscribed. So all that together equals a big mess for them, so they're going to be specifically targeting people who they think are more risky. So if you've missed payments in the past, if you have your cards maxed out, you can be targeted. And remember, larger banks are doing this, but don't think that just because you bank with a smaller bank that you are exempt. It's important to realize that these smaller banks get a lot of their money from larger banks. They'll take out what you call a warehouse line. So if they want to loan money to you, they'll borrow it from Wells Fargo, okay? And Wells Fargo will only charge them 1% for the money, and then they'll turn around and charge you 3%, and they keep that spread. We are so interconnected on many different fields, not just, within the banking system, but also as a whole globe, that when things are done over here, it's felt everywhere else. So what should you do? If this has not happened to you yet, and you are someone who is dependent on your credit cards, I strongly suggest trying to really budget your money and figure out where you can reallocate your funds so that you are not having to live off of your credit card. You will be surprised where you can find extra money if you're eating out too much, which obviously we're not doing. I think a lot of people can actually see how much money that they've spent on frivolous things because you literally cannot. You cannot spend on frivolous things right now. You can only really go to the grocery store and right back. So take this time to really analyze, wow, like I really spend a lot of money at Starbucks or wherever, and reallocate that into managing your money better, paying off your debt, paying down your bills. And like I mentioned, they are going to become a little bit more strict. So if you are somebody who maybe you want to get a balance transfer credit card, which I talk about in this video up here, so you can check it out, but consider tapping into any of those extra loans that you can right now, because I do see there being issues with being able to get qualified for those loans in the future, because as this problem progresses, they are only going to be more strict on who they're going to give money to. And another caveat, I don't want people going out taking loans because they're going to put themselves in a worse financial position. I don't want you to get another credit card and then end up maxing out both of those credit cards. That's terrible for your credit. but this is if you were already looking to be aggressive with paying down your debt, and this may help, right? Because if you have a credit card at Chase at 22%, and then guess what, they just slashed your credit limit, well, now you definitely can't use that card anymore, and now you're stuck with this high interest rate. So if you were to go into a balance transfer card, you can move that money into this new card, enjoy a 0% APR for the first, I don't know, 15 or 18 months, and then aggressively pay that down. Credit card debt is the devil, okay? It makes no sense that banks can get money from the Federal Reserve at literally 0%, and then they turn around and charge us 17% or even more for that same exact money that really didn't cost anybody anything. Another option is to get a personal loan. Again, this is things that I want you to do if you are looking to improve your situation. I don't want you to get in a worse position financially if you do these things, but a personal loan would give you a nice flat payment, and it's normally at a much lower interest rate. Normally single digits. Credit cards are pretty much always double digits, 10% and above. Personal loans are typically better depending on your credit. Obviously, I can't really speak for everybody, but they are offering more competitive interest rates. They will consolidate that debt for you. If you have everything in one interest rate, that could also improve your credit score, because remember, if they cut your credit limit, that will cut your credit score, because a part of your credit score is based on your utilization, which basically means if you have 10,000 and you used 5,000, well, you have a 50% utilization. If they cut it down to 5,000, well, now you're at 100% utilization, which sucks. Another option to think about is home equity. And, again, I want to tread cautiously, because I don't want people to just start going out there and refinancing their homes without really thinking things through. But refinancing could dramatically help you, because depending on when you got your home, you might be able to save in interest, because interest right now, I think I saw somebody in my comments said they paid 3.2% on their home. So if you're somebody who maybe you got it at the 4% mark, 5%, and you want to kind of refinance, you could potentially get a lower payment, or keep your payment the same but pull some of that equity out of your home. And I think that's important to do, because liquidity is drying up. You might not have that option in the future because your home price might go down. And I have a video up here talking about why I think home prices will be collapsing in the future. I don't know how long it will take. As a reminder, in 2008, it took the housing market 4 years to actually bottom. So I don't know when this is going to be, and if anybody tells you they know when, they lying. My personal opinion is it's better that I grab onto that equity rather than the banks, right? Because I got this equity. If I refinance, well, now the equity is mine. If I don't refinance, the equity vanishes. Another thing to consider if you're looking for some extra money is pulling out of your 401k. I want you guys to really look into everything that I'm saying and make an educated decision. Don't just make a decision because you watched this video, but go look into it yourself and crunch the numbers and make it make sense to you before you pull the trigger on any of this. But with the CARES Act, they've actually waived the 401k penalty. So it doesn't matter what age you are, you can pull up to $100,000 out of your 401k penalty free. Now the caveat there is that you have to pay it back within 3 years. So I almost don't even want to suggest this, because so much can happen in 3 years. What if you're not even working at that job anymore? Are they going to ask you for that money back right then and there? Or are they going to consider that an early withdrawal? If you do want to pull money out, I strongly suggest you talk to your HR department to figure out those things, because you don't want to be in a position where maybe you get laid off because things are looking even worse this time next year, and then you have to deal with not having a job and figuring out how you're going to pay back this 401k loan. But if you are comfortable with doing that, it might make sense, because you can pull that out and pay off your credit card debt, which would be a guaranteed return on investment. Or I guess it's not really an investment, but when you pay off that debt, whatever the interest rate was, that's literally what you're going to be saving, because you no longer have that debt. So if you were going to have that credit card debt for like another year or so, you could potentially save guaranteed 17% or 20%, depending on what your interest rate is. So like I've mentioned before, it's just really important to really think about everything that is going on and really evaluate what you spend on and what you can get rid of, because if you do have a dependency on these credit cards, that lifeline might not be there anymore. That is why it is so important to be as self-sufficient as possible. Obviously, we don't all have access to, you know, a farm where we can just make our own food, but you know, to the extent that it's available to you, really try to be as self-sufficient as possible. Really try to use as little of your income as possible. Don't start buying fancy things when things look like they're getting back to normal, because the economy is in trouble. I'm not being negative. That's giving you the education that you guys deserve. All right, that is it for this video. If you liked it, please give me a nice big thumbs up and subscribe and share with your friends. And if you're not doing anything else, you know what to do. Binge watch me. And until next time, keep your money up.